exploring the investment landscape with a guru's wisdom and a strategist's insight. Good Life Companies presents The Market Enthusiast with Noah Brooks and Chris Needs.
Welcome back, everybody, to the Market Enthusiast podcast. I'm Noah Brooks, and of course, with me today, Chris Needs. Last time I saw you, we were at an airport restaurant on Friday afternoon. What transpired after that?
I was departing onto a wedding in Austin, Texas, and if you can hear, my voice isn't in the best of health. I did a lot of singing on the bus on the way back. It was about a 45-minute bus back from the venue.
Why were you guys singing?
Because that's what you do.
That's what you do at weddings? I'm not a wedding singer.
It's like scream singing.
Scream singing. Oh, man. I would have hate to be the sober person on that bus, like the bus driver.
Yeah, definitely would have.
Yeah. So we were departing after the Good Life Advisor Conference, and we did a little recap of that yesterday, so I won't go too much into details. But we had a great few days in Nashville. We saw a lot of advisors down there, really good experience. And I guess the takeaway that I will put out here is, taxes are really important from a holistic standpoint. Advisors need to be aware of it. Clients are asking for it. And it's something that really should be on the forefront for most advisors, and it certainly is for clients. So if you're out there listening, it's we're coming down to tax time, right?
Yes, we are.
A few months away. That also brings me to one thing. So new rules for required minimum distributions out there. For anybody that turned 72 in 2023, 2024 is going to be the first year that you're going to have to take that. That's a little bit of a change from the past, 70 and a half. I guess people can defer it until 2025, but then they have to take two distributions in the same year. Taxes are changing. The tax rates for 2025 are official, and they're out there right now. Nothing dramatic in terms of changes, but what do we have going on in the next few weeks? Anything big?
We do have the election,
of
right, course.
The elections next week.
That'll have some impact on tax policy, from what we're hearing.
Oh, you think? Now you're a guy who's into taxes. Do you think that taxes are going to go up or down in the future?
I mean, in the long term, you would think they have to go up. Do I want them to? That's a different question.
Seems like they're going to go up in the future, right? I don't know that we're going to be able to grow our way out of the.
So if you can utilize a Roth, is that what you're getting at?
Absolutely, right? I mean, we talked about RMDs there for a second. People that are able to contribute to a Roth, that is the best possible way to do it. You put your money in, it's after tax money. And when you take it out, there's no tax due. For people that are above the income limits, and there's a few people out there that are certainly, you can do Roth conversions, backdoor Roths, things like that. It's a great way to get money in there. And for people that are in the pre-retirement age, there's kind of a sweet spot there before you start collecting Social Security, before you start taking required minimum distributions. But maybe after your peak earning years, kind of the sweet spot to be able to take money from your traditional IRA, roll it over to your Roth. And there's some people out there that, if they don't have a lot of earned income, you'll be able to do a fair chunk of change and make it really worthwhile. The longer that you have to make it happen, the better it is, because the Roth has no required minimum distributions. That's a key point to the whole thing. And for anybody out there that has the option of a 401k that has the Roth side to it, if you are not doing that, and I know some people say, well, I'm in a high tax bracket, I want to get the most I can from a deduction, or not a deduction, but a deferred on taxes. Putting the money into the Roth now, oh man, the compounding and the fact that you don't have to take it out for required minimum distributions, it doesn't get much better than that, especially in the 401k. I'm 100% of my contribution is going into the 401k, the Roth side of it. Do Do you? Wait, you're going to tell me that you don't use any of it?
I'm looking at it.
Oh my goodness.
I just have a problem with taxes. I'd rather not pay them ever, but I should be smarter about it.
But in the
It's a
long
personal
run,
decision.
you're going to wind
Yeah.
up paying
You're
more
right.
taxes by not paying them now.
Yep. You're not wrong.
Okay, everybody.
Back to our regularly scheduled programming here.
Let's come back to this. You know what we should do is we should get a tax, not a tax preparer. We should get someone who specializes in RMDs and taxation on here just to give us a few pros and cons.
A little special for tax season.
Yeah, a little special for tax season coming
good,
up,
yeah.
even though it's not really tax season. But end of year tax loss harvesting is coming up, tax planning, and the election. All right. So I said it's 7 days till the election. I think we're on knife's edge, depending on who you talk to. They either know Donald Trump's going to win or they know Vice President Harris is going to win, right? They absolutely know. I don't know who's going to win. I have no idea. You have a thought? Not who you want, but like.
Yeah, I mean, you see a little bit of this Trump trade coming back. Bitcoin's doing its thing. You hear this Trump trade that may be gaining a little steam. You may say the market's betting a certain way right now, but it's a toss-up. It's all about turnout at this point. I'm sure everyone's made up their mind, I would guess. Even early voting is at least concluding, I think, today in Pennsylvania. But it's all about turnout.
Yeah, there's no question about it. If the Trump DJT stock was an indicator, it would probably be indicating a win for him, because after the we'll call it a botched debate, DJT went down, and I think it got down to like $13 a share, $12 a share from 35 or 40. It went all the way down, and now it's come all the way back up, even though it only has
no earnings,
almost no revenue, something like that.
If you like companies like that, there you go.
It's not my cup of tea, but there's a lot of people out there that I know that have bought it personally. So that's I guess it could be an indicator. Doesn't seem likely that it's going to do anything, but for an indicator for the election, possibly.
I don't take my betting odds from companies like that. Me personally.
Yeah, no, I wouldn't do that. I wouldn't do that. But yeah, I mean, there's definitely, who you talk to is where you are. Those biases out there are running really hard right now, and I don't think anybody knows. I think it's kind of one of those unknowable things. It doesn't seem like the market cares to me. It's really about earnings. I think you'd said earlier, Google came in and crushed it this afternoon.
Yeah, they had great numbers. That's what we like to see. Obviously, those mega caps doing well. We would like to have them back outperforming, and then keep the market doing what it's been doing. Because I know you commented on our last one, the Mag 7 haven't necessarily been pulling the cart as much lately. So if they start chugging again, that'd be a good thing.
I'd rather see the small caps rally personally.
I'd like to see everything rally. I was surprised yesterday. I mean, so where we're at right now is yields are still coming up. I'll call it pretty aggressively all of October, but small caps yesterday had a strong day. Yeah. Something you wouldn't expect to see.
Yeah, no question about it. You mentioned yields coming back up. Mortgage rates are actually significantly higher than they were a month ago, shortly after the Fed raised. I think the average 30-year in the U.S. Is back over 6.5%.
The 10-year's up to over 4.3 again. So, yeah, highest they've been since early summer, I would say, or late spring.
Yeah. Yields, if you will, normalizing the 10 minus 2, meaning the 10-year yield minus the 2-year yield, which was inverted for, I think, 30 months plus, uninverted after the Federal Reserve lowered. And now we're at 16 basis points difference between the two, meaning the 10-year higher. It's the highest it's been since May of 2022. So a normalization in yields where the longer you go out, the higher it is, and not a lot. 16 basis points is not, it's not going to make or break the day, but seems to be moving in the right direction.
Yeah. In tandem with that, we have the ag in its longest drawdown ever, 50 months. The next longest is 16 months. So obviously a very dramatic drawdown in terms of length.
Yeah.
Spreads are super tight right now. I know on high yield spreads, it's down to below 2.9 again, which is the tightest since June of 2007.
Yeah.
So,
there's a few different ways to look at that. It's like, okay, the economy is working so hard and everything is moving in the right direction. So these spreads are so tight. And you could make a case that when it gets low like this, it's time for the economy to start slowing down.
And historically, if you look at it, that's sort of what it does say. Right now we're looking at a snapshot in history. It's because fundamentals are great. And right now the market isn't forecasting a recession. That's what high yields are telling you if you look at them sort of in a vacuum. But, in terms of historically, when spreads are this tight, you do have smaller returns on both equity and on credit if you look out on like a 5-year time horizon historically. So it may not be the best thing. It's not a terrible thing. Obviously, we don't want spreads to blow out because that means something's breaking.
Well,
but forward returns aren't the best when spreads get this tight generally.
I think what it means is, if you don't currently own high yields, it's probably not the best time to start a position in high yield bonds. If you've owned them and owned them for a while, you've made some decent money. Not only have you had appreciation, but you've also had some really good interest, right? I mean, there's no question about high yield has a much better total return over the last few years than the bond ag or corporates, things like that. So if you don't currently own high yields, I wouldn't be buying them, but I don't know that it means that you got to get out at the moment.
Yeah. Interestingly, if you look at S&P 500 forward returns over 5 years in that scenario, so what we ran was the tightest 20% of spreads. The forward 5-year annualized return is 2.9% per year. So obviously that's not what we're used to. That's not what you expect. That's not necessarily near average of what the S&P 500 returns. And high yield credit returns on average in those scenarios 4.9%.
Yeah. Looking back, I was running actually numbers today and yesterday. The total return for the S&P 500 for the last 12 months, not year to date, for 12 calendar months is over 40%. I mean, if you missed that rally, if you're an investor or an advisor or someone that likes decent returns and you missed that rally because you were worried about the war in Ukraine, you're worried about the geopolitical situation, you're worried about the election here, if you missed a 40% rally in the S&P 500, you really did yourself an injustice over a long period of time in terms of building wealth. It is very difficult to get that money back. I mean, you have to be right after being right after being right to make up for that return.
And those same people will be tempted now to try and catch up. And that's right when, just as Mr. Market does, seems to get you in trouble.
Yeah. Do you think the rest of the year is going to be just as calm as the last month?
I personally don't think so. I think we're going to see a little bit of a lull after the election. I mean, we have run up right into it. So we just came off, 6 straight weeks of wins on a weekly for the S&P 500. The NASDAQ actually continued that streak 7 weeks. Normally, I would say before the election, you'll see some jitters, maybe a VIX spike. But since we didn't get before, I'm starting to think we might see it after. Just my personal take.
Yeah. So buy the rumor, sell the news type of scenario?
I think that's fair.
Yeah. Normally, with an election coming up, and I say normally, I don't have anything right here except anecdotal data, but like everybody gets a little bit crazy when there's an election coming up. And yeah, I think there's an air of an anxiety when I talk to people, no matter who they're voting for. Everybody seems a little anxious. The market does not.
Yeah.
Which I think is great. It's a great sign for the economy that the economy is strong, corporate profits are strong, and the consumer is very, very resilient.
Yeah, that's one thing we heard this weekend, how resilient the consumer's been, and we've sort of been aware of that. We've been talking about it as well. we just hang in there. You hear those those headlines like credit cards above 1 trillion and all these things, delinquencies ticking up, all these different headlines. But in the end, if you're looking at the dollars being paid, you look at the real wages, which are still hanging in there and right now far above inflation. At least I consider it far above. It would say about, call it 1.5% higher than inflation. That's good for the consumer. They're the people spending the money.
I would like to see mortgage rates come down. We had some data last week with new home sales, or excuse me, existing home sales, and they kind of underperformed a little bit. It was on an annualized basis, it was probably the lowest in, I think it was 16 years, 15 years.
I have a stat that is slightly outdated. I didn't see any updated September numbers, but through the first 8 months of the year, housing turnover fell to 2.5% over those first 8 months of the year, which is the lowest in over 30 years.
Wow.
So think about when rates do eventually come down, hopefully. Think about all the money locked up in all these houses that have appreciated. Everyone talks about money markets and how much of that will flow into equities or bonds. I'm not so sure a high percentage of that will filter down.
Why do you wait? Hold on. Why do you say that?
I think a lot of people look at the money market. They took it from their banks, their sort of cash cushions, and put it into money markets. I don't think it was natural market dollars, if that's a thing. I think when it comes to the housing market, people will start pull money out of their house, do refis when the rate comes down to something reasonable. And there's a lot of wealth locked up there that I think people will be doing more things, whether it's just flat out spending in the economy, whether it's additions or new cars or maybe a boat. And they'll do something good with it, unlike these money market dollars that maybe only 20 or 30% maybe might flow into the market.
I can see when yields go higher, longer term yields, right? Not short term yields. I can see when yields go higher, money coming out of the money markets and going into some longer term, whether it's treasuries, CDs, corporate bonds. One of the big issues with people putting money into the money markets over the last year or two has been that short-term yields significantly higher than long-term yields, and there was really no downside. I mean, there's an opportunity cost to having it in the money market. I just said the S&P's been up 40% over the last 12 calendar months. But from a behavioral standpoint, from like a sense of safety standpoint, there's no downside, or there hasn't been a downside to getting, clipping a 5% coupon with virtually no risk in a money market mutual fund and not having to worry about whether it's running a bond ladder or what rates are going to do, just knowing that you're getting your 5%. And this is why I say I think as rates go up and the short-term yield either stays flat or comes down with the Federal Reserve lowering, I think the money might flow out of money market funds into some longer duration treasuries or CDs or something like that.
I think that's a rational decision, and I hope you're right. I just don't think 100, obviously never 100%, but I just think about what I did. I took my excess savings and I essentially put them into my account, boom, into my market, got the extra yield since, we'll say Wells Fargo's paying like 0.1%. So, I wasn't going to leave it in there, and that's an opportunity cost for not doing anything, and I moved it, but I'm not going to then leave that all in there. Eventually, I'll probably shift some of it back. I don't know what percentage, haven't gotten to plan that out yet, but I think there's people like that where it's like some of that money isn't earmarked for the market.
Yeah. I mean, everybody wants a little bit of cash on hand for an emergency. And depending on who you talk to, maybe it's a few months. I like to think more like 6 months to a year. Some people who are a little bit more conservative or may have a higher net worth, depending on what their job situation is, they could have up to 2 years worth of cash on hand. And it doesn't have to be in cash, but money market, CD, something like that. And it really gives you the confidence to ride up and down in the market when you have that type of cash on hand.
Yeah.
So you don't have to be worried about, oh, listen, if the market goes down by 30 or 40% in 2024, 2025, I'm going to have to, get a second job, or I'm going to have to change my way of living. Well, I have 2 years of money right here on the sidelines, and it just gives you that little bit of extra confidence.
Mm-hmm.
Yeah. I recommend a few months. At a minimum.
Yeah.
At a minimum. I run into people all the time that don't. I mean, it's not a paycheck to paycheck thing, but they just don't have a lot of money saving, money invested, income, but nothing in like no real substantial money in liquidity products.
I mean, with how markets have been, maybe some people have gotten comfortable with, just having it 2-3 days away via ACH to just pull it immediately out of the market. But then you have to deal with fluctuations if you have an ill-timed cash need.
Yeah. We don't want to deal with that. You mentioned the lowest turnover, right? Lowest housing turnover, and obviously mortgage rates are really going to play into this. At some point, though, rates are, we're expecting rates to come down. Do I know that they're going to come down? No, and certainly not 10-year. The expectation is for short-term rates to come down, but overall the whole curve to come down. Is it possible that rates, especially mortgage rates, don't go down at all?
I think the fear is, and we've heard a couple Fed guys talk on thinking specifically. Kashkari has mentioned sort of our deficit spending and our debt growing almost exponentially at this point is going to push the natural rate up. So neutral isn't going to be maybe in the 2.5% range. It's going to push it up because people are going to have to take an extra risk premium for our ballooning debt. Now, that the GDP isn't outlandish yet, but the nominal overall debt level is very high. And I think that will have the long end elevated.
Yeah. One of the things that has really been working this year is gold, right? Precious metals. And gold's up over 30% year to date. And a lot of people are starting to say there's a reason that gold's up, and it has to do with the national debt, not so much inflation, but the fact that, we do have an election here. We don't really know what's going to happen. And if we're in a situation where there's dramatic cost cutting that comes into play, Donald Trump's talking about Elon Musk coming in and trimming $2 trillion from
the Doge department.
I couldn't possibly come up with $2 trillion in cuts. That's basically cutting a lot of the social services, whether that's Medicare, Medicaid, Social Security. That would involve big cuts there. But the fact of the matter is that the debt service, the interest on the national debt, is something close to $1 trillion.
I think it's up to like 1.2. Now that'll change next year if rates start coming down a little bit, but for this year, I think that's what we're looking at for a year-end number.
That is a lot of money to be paying on your debt. They should do like some type of consolidation loan.
Yeah, they should refi.
Right?
Not these rates.
Yeah, no. Well, that's what it is. Rates come down, it's better for that number on an absolute basis. Mm-hmm. But we can't just continue to rack up the national debt. There's got to be some type of I don't know if it's a come to Jesus moment, but the markets will eventually give politicians a come to Jesus moment.
Yeah. And strangely, we're seeing the dollar up, though, during all this with gold up.
Yeah.
The dollar's been outperforming the euro and the yen. So, the main reasons behind that are we have a higher real interest rate than them. We're at about 2.5%. The euro's at I think 1.5%, and the yen's negative, obviously. And we have better growth than them. We have much better growth than the European Union right now. Their economy has been sort of slow. They're more, I feel like my opinion of them is like a value area, like value stock area. I just have that opinion in my head. I don't know
of Europe.
Yeah, it's just compared to us, we're growth, their value. It's just been this thing in my head for a long time now. And we obviously have much better growth than Japan as well.
Is that a regulatory outlook? Do you think that their growth, because they have tech companies, right?
They do.
They don't have the Googles and the Microsofts of the world, but they have a lot of large tech companies. They just have not performed near as well as our tech companies.
Yeah, we've talked about the regulatory scrutiny over there, which is much higher than ours. It seems like in everywhere, even if you talk about food, they're more strict with their regulations. It just maybe is part of the
safety. Health and safety.
Yeah, it just seems like that's a part of their culture and their thing. And I think we talked about before, if you're going to start a new business and it's a growth business, you might want to come here rather than there. But they do have like ASML. That's one of their big ones over there. ARM is in Britain, I believe, though. I don't know how that gets
Netherlands.
Netherlands, okay. So those are two big ones, but from the tech side, growth tech side, there's not much over there.
I mean, from a growth standpoint, the United States has certainly killed it versus the rest of the world. There's no question about that. And some of the brands out there, as I say it, the first thing I think of is like McDonald's and Boeing, and obviously Microsoft and Apple. But like McDonald's and Boeing have been getting kicked in the teeth. McDonald's a little bit over the last few weeks, right?
They had a little E. coli outbreak in the quarter pounders.
Oh,
yeah,
man.
I guess one person was unfortunately passed away, and then there was like 75 injured is the number I saw.
Yeah.
So not good for the headlines for sure. But then Boeing just dealt with their strike. They just came out of it. Apparently they cut a deal in the round of 35% annual compensation, or not annual, 35% compensation increase, I guess, over the contract. Nothing with the pension. That was a big sticking point for a long while. But the estimates are of like $5 billion lost from almost a 2-month strike.
Yeah.
It's a lot of money.
I not only did they lay people off, but their suppliers laid people off, right? Because they didn't know how long this was going to go on.
And they had to issue shares too, right?
Yeah, I think that was today, if I'm not mistaken, or yesterday. I'm going to go back to McDonald's for a second. I don't know if anybody out there listening tried the chicken Big Mac. I did one over the weekend. It was gross.
I tried one. I didn't think it was gross, but I mean, honestly, it's still McDonald's.
There's something about that Big Mac sauce, and I'll eat a Big Mac, but there's something about that Big Mac sauce on chicken that was just
strange.
It really did not appeal to me in any way. While we're on food, there was a stat that came out this weekend. It says the average American eats upwards of 80 pounds of sugar in a given year. And I actually thought about it, and I vacillated in my mind. Do I eat more or less than 80 pounds? I think I might be over.
I don't even want to know what my level is.
The Soda King?
That's me.
Did you drink a lot of soda at the conference?
Less than I would have if I was at home.
Oh, really?
Yeah. Probably
is that because they didn't
2
have
cans
soda
a day? No, they did. They did have soda. I probably had like 2 cans a day.
80 pounds a year. That is a lot of soda to drink.
Yeah. Think about if you like bag that out, you just get sugar and put it in. That's like enormous.
Yeah. That's a lot. So we do have a little bit of economic data coming out later this week. We have the jobs report coming out. Anecdotally, I've seen some situations where companies are holding off on hiring until after the election. I don't, last month we had kind of, I don't know if it was a blowout, but it was 245,000, and I think the consensus was like for 145,000. I guess that would be a blowout.
Yeah.
And the month prior to that, it was more like 112, 115,
114. Yeah,
114.
They're calling for 120 on Friday.
So where does this go if we get another? If it starts with a 2 again, and they're still calling for a 145?
That will make it tough. That will make it tough to cut. I would argue. We got JOLTS data today that was good if you're looking at it from the perspective of wanting another cut. 7.44 million jobs open versus 7.9 million was expectation. So that's pretty cool from the economic perspective.
Yeah.
But yeah, if we get another 200 handle on jobs, I think we're going to see those odds, which I think are around 90% or so
of a quarter
for a quarter point cut. I think that's going to go down pretty quickly if we have a 2 handle again.
So higher for longer is real.
Potentially, yeah.
I had the pleasure of meeting one of our advisors at the conference, first time that I had met him face to face, and he says to me something to the effect of, "I think the Fed lowered too much too early." And I started saying that, inflation is coming down and PCE is at like 2.6 and core inflation is down dramatically. And he didn't want to hear it. He said to me that, without question, they've lowered too fast. And they only had one rate cut.
obviously anyone can debate the merits of either side, and we heard the other side of it when they didn't cut in July, and then people were angry with them for that. But core has been above 3% for 41 months now.
Yeah.
That is the longest streak back to, well, it was a gigantic streak. It was the late 70s to early 90s, but we hadn't experienced that from the early 90s on. So I can see maybe where they're coming from. We're just going to reignite the fire potentially, but in the short term, I don't think inflation expectations are going to be unhinged and go back upwards.
Yeah. I hope not. I mean, inflation is going to be, it's going to be the talk of the town for the next week, maybe even for the next year. All right. Well, that wraps it up for us. I want to thank everybody for listening today, advisors, investors, anybody else that's out there. For the Market Enthusiast, I'm Noah Brooks, and with me, Chris Needs. Any questions, comments, concerns, anything that you want to talk about, send them our way, the Market Enthusiast at goodlifefa.com. We'll see you next time.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.